Market AM report for Thursday, T-1. That's tax day tomorrow. It's paying Uncle Sam. And here's a quick snapshot of what's going on and hopefully some precision forecasting. Every single one of my video casts from the past couple of weeks, in fact, the past couple of months, overall, with more than 80% probability, has come to fruition, both on the long side and also on the short side. Of course, we're talking about the long side at this point, given what you're seeing in the backdrop, which is the S&P 500. Let me make this simple and go over a couple of observations and then some precision technical forecasting. Pattern symmetry, as I've talked about extensively in my advanced coaching sessions, in my video casts, are critical to markets. Yet, majority of analysts, traders, investors refuse to believe it. Pattern symmetry is nothing but technical manifestation on charts of human behavior. Human behavior never changes, and the bottom line is, given the fact that a majority, and that's been shown through actual numbers, that a majority of institutional and hedge funds and speculators are net short the market, is causing a massive short squeeze rally. There are some fundamental backdrops that have been improving lately. China's export numbers were very strong. We have had some stabilization on the Japanese yen, which was falling apart below 108, now heading towards 110. And I've showed those charts a few times. Suggest you take a look at them on your own screens. Macro factors such as liquidity pumps by central banks are in full gear. Our own Fed, the U.S. Federal Reserve System, has openly said numerous times, yet many refuse to believe, that regardless of improvements within the economy, they're willing to hold rates lower longer. So on the backdrop of that, the earnings season started off with roughly a negative 7% or more earnings estimates revisions by Wall Street analysts. So what that basically means, if you want to be a contrarian, is that any slight beat on the part of companies reporting will cause markets to go higher. That's pretty much what's in motion right now. Lower the expectations, then you beat the lowered expectations, and things start to move. You saw that with CSX recently. You saw that with a bunch of other companies. JP Morgan was critical yesterday with large bank earnings coming into play, and despite some softening numbers and a moderate guidance, the stock was up sharply, causing a large financial rally, caused S&P 500 and the Dow Jones Industrial Average to go higher. Saying all that, do not get complacent. This is a market driven by machines, algorithmic high-frequency trading programs, and I can assure you that right when traders and investors start to get lazy, you're going to get hit. Technical patterns are extremely important. There are swing patterns which suggest upside, and there are short-term patterns which are saying that the markets are truly, on a short-term basis, overbought and will have intraday pullbacks, which can be anywhere from 100 to 300 points. Expect that to come by the early part of next week, in my opinion. So be cautious in the sense that if you have large profits, you want to scale out of a bunch of them and protect your account. Effective account management is key. Okay, so let's take a look at the S&P 500 right here. You can see that the top here back in May of 2015. Then another top here, a retest of the top back in July 20th, and then you had this large flash crash. I've showed this many times, but repeating again. And you have, let me get my marker here. Okay, so you had this, then you had a retest in September, causing a formation of, resulting in a dragon bullish formation, a simple W formation, which generated into a massive move higher, which was unexpected. Then at the same time, it was simply reversing back to the mean and then well above that. And the reasons behind all these falls are pretty much always the same. Credit concerns, high yield junk bond defaults, central bank actions, and you name it. All right. So the old saying that I used to say back on Wall Street to my clients was every crisis is the same for different reasons, and that's pretty much the long and short of the story. So you had this, then if you looked at this downward channel, then it fell within the channel, had some very wide swings, and then fell apart again back in early January, which was a terrible month, culminating in a lows back in culminating in the lows of in middle of January, then a reversal bounce, and then a lower low, well, actually similar low, lower low than this in the 1800 level. And at that point, the despondency and despair was at its max. If you go back and listen to my video cast from that time, look at my charts from that period, you're going to see that there were some positive divergences coming into play, and that what resulted in this particular move. By this time, the shorts were getting complacent, and from what I understand from my readings, that there is more than a $1 trillion. That's $1 trillion short bet against the market, which at this point is in the process of decimation. In other words, the short squeeze, which causes the markets to move higher, is in play. Two things to keep in mind if you want to look at long-term pictures, swing pictures. When you have a crossover, the 34 and the 50, you generally get the next surge. That's the level that we're in right now. We don't have too much. The upside is limited at this point, in my opinion. I believe that this level here in the 2096, 2100 level is the one that the market is going to hit some serious resistance, as we did in this supply zone here, where some very large selling occurred. At that point, you could have a myriad of technical retracements, and 2020, the rising uptrend line on the 34 and the 50 come into play at 2020, I should say, and then at 1983. Now, if these lines keep on rising, that means the market is in an uptrend. If the lines start turning over, that's when you know that things are starting to soften up and the big boys are getting out of town. All right. In the meantime, we are in the overbought territory at 98 on the stochastics. You can see that the simplest way of gauging overbought and oversold conditions. I've taught this extensively. Of course, there are many ways to read this, but this is the simplest one that everyone should follow. You can apply that to stock trading as well as index trading in the form of S&P 500s, Russell 2000, and such. Okay, so let me get all these drawings out of the picture here. So what we see here right now, we're engaging a supply zone right here, which is the zone we're in right now, which is around that 2081, 2082 level, right? And so this is going to act as resistance. You could have a quick pullback, which could generate 100 to 150 point drop in the market, testing this consolidation channel, which I had also clearly shown about 2 weeks ago. Or more than a week ago, and that consolidation channel obviously broke out. The lower end of the consolidation channel remains 2020. I figured that we might have dropped at that point, but the Saudi-Iranian supposed deal on oil upward freeze caused this candle to appear, and the limited short positions that I had and some others had got blown out of the water. Okay, and then you had these two very large candles that you can see here, right there. You can see that. 1, 2, and that's as of yesterday. So this zone to come up to the zone, the upper end of the Bollinger remains at 2096, and so far the trend is on the upside on the daily charts. Intraday will look different because we are severely overbought on the 1 hour and also on the 4 hour charts. So do expect some volatility to occur at these levels that I'm talking about. Take a good look at this, all right? So there are very powerful patterns here. A rising wedge, a consolidation channel, and then a breakout of the channel. Good. Now there are two other, I want to keep this simple today, so that's what's important. One of the other ones, which is the Japanese yen, which seems to be dictating trading in the global markets these days, is on the rise. It is on a severe downtrend. You can see that. But if you look to see on the daily, you're starting to see that this mechanical selling that caused the market to drop very hard over the past last week or so is starting to reverse itself. The reversal at this point, in my opinion, should be capped around 110.65. Um, and then, of course, the retest of the downward sloping. The keyword is downward sloping. 111.83 on the yen remains into effect. If we break out over the 50 and the 34-day moving average, then the reversal trend changes completely. And at that point, it is going to be extremely positive for markets going forward. So at this point, this is a key factor that's in play. Any break below 107 or 108 is considered negative, and you'll expect the market to get back on the risk-off stage, in which case you're going to see markets drop. Now, people might think, some newer people, members and free trial subscribers, and welcome, might think, what's so important about all these big macro global factors? We're just trading stocks. Well, the stocks don't trade in a vacuum. They trade in machine-driven, algorithmic, high-frequency trading programs that dominate the landscape with the backdrop of the markets and the global markets in focus. So it's very, very important that you understand what's driving the markets in order for effective trade management, which is obviously key. So that's a quick snapshot of this particular picture here. Oil has also been a powerful driver of the market, and so far oil has been on a tear, and you can see here clearly, and these magenta lines are basically the Darvis box that you can automatically transpose on your own platforms. And you can see here oil is certainly getting overbought. There's no question about that on the daily charts. And at this point, the upper end of the move is 43.49. It is still trending higher, and it's a perfect pattern symmetry with a V pattern, as you can see that right here. And we are hitting resistance up at this level. So again, what I'm trying to get at is very simple. All these things move in correlation, and you need to basically monitor them. The 34-50-day moving average breakout is key. That happened, and despite this pullback in oil, these lines were moving higher. That was a positive divergence. Okay? Even though oil fell from 43 down to 36, the fact remained that the so-called invisible smart money was continuing to add to their long positions from this 36 level onwards, and this consolidation triangle now is breaking higher, right? Heavy resistance at this level, no question about it. At one point or another, which I think will come in the latter part of the summer, as summer driving season comes into full gear, output cuts and all those freezes go into effect, oil demand starts to rise, maybe some stronger economic numbers coming out of China, you're going to start to see oil move towards this $50 level, which is a back test of this rising channel. And when it gets back in this channel, then you're going to see a shoot up and a very sharp move up towards the 57.5, which also happens to be the gap fill here, going back all the way to June of last year. Okay, remember, analysts sitting on their ivory towers on Wall Street predict all these things and making a couple of $1 million a year for predicting wrong stuff. And here we are sitting at Clueless A Trading, and we are looking at stuff and analyzing stuff on a very predictive, precise fashion for a mere pittance of a monthly rate. So the incredible value-added service that you all are getting from understanding the global markets, understanding stock trading, which we have a very stellar performance record, is precious. I suggest referrals. I suggest you guys sign up for the advanced coaching sessions so you can understand and effectively benefit and effectively manage your trades better. All right, let's move on. So two charts I'm going to show to end off this thing here, keep it nice and short, is number one, the SWING533. Now this is a chart that I track from a swing standpoint, and I'll tell you that it's been a very helpful indicator, even though during volatility-driven, heavy volatility-driven periods, it tends to issue difficult. It tends to be difficult to predict. However, this is pretty clear cut and dry. At this point, what you're seeing here is overbought conditions developing in the 90 range on the RSI. You can see that. There's many ways to read this. It's not as simple. But anyway, anytime you have a crossover of the stows, like you see here, you tend to start off a powerful short-term rally. Markets are moving within a range. The range is 2100 and the low end of the range is 1900. So that's roughly about 1,000 to 1,200 points in the Dow that the markets are moving in. Want to keep it simple? The markets are moving between 17,000 and 18,000 on the Dow. Very large swings. In the meantime, the trend at this point, this was the candle from yesterday. You can see here what's happening with the internal stows. What's happening, what I believe will happen is these histograms, I'm sorry, internal histograms, MACD histograms, are going to attempt to go positive. Whether or not it's going to pull something of this magnitude, which is huge, and that's why this rally, started off from those levels, I think remains a low probability. I believe that if we go positive as we get towards the latter part of April, you will see a peak up in that 5 range, and then you're going to start to see a rollover as we get into May. That's just my prediction. All right. In the meantime, this level of 90, maybe it moves sideways for a little bit as we get into monthly options expiration tomorrow. Like I said, monthly options expiration week is generally a bullish week. That's been shown by statistical facts too, and what I call statistical historical numbers. The bottom line is that that you will get a reset, and that reset can be at 50 RSI, or it can come down and go below 30. Anytime it goes below 30, as you know, it becomes somewhat of a buying opportunity. All right, final chart that I'm going to show, something you guys are all familiar with, is the Nymo. All right, and that's the Nasdaq. I'm sorry, the New York Stock Exchange McClellan oscillator. Let me get in the picture right now. What's going on? Okay. Oh, this is what's going on. Okay, so now the simple things that you can use on your own. Remember, try to keep this thing simple. There's a lot of technical jargon that goes into play. There's a lot, I can make these charts 30 times more difficult for people to understand and make myself look I'm like the smartest guy in town, which I'm not. Okay, I just read markets better. I have a deep understanding of global economics and finance. That's my passion. And I love what I do, and I'm grateful for everything that we have. And God bless America and the United States of America for giving us the chance to do what we do, and that I truly and deeply believe in, and I'm sure a lot of you do too. So here we have a chart of the Nymo, and what you have here is very interesting. Okay, you got the oversold conditions at negative 45 on the pullback last week, and now this is where we are. This is what's interesting. Okay, two things here. The ADX line, which shows a directional indicator, plus DI, and negative directional indicator. That's a positive directional indicator, obviously, the green one. The red one is the negative one, is showing that this is still pointing down. The green line is still pointing up. Okay, at one point it becomes like this. It points up and then it starts to come down. So when you start to see the DI, the ADX and the DI indicators, also called the vortex indicator, the VI you can use, do that, then you start to see the market topping. It happens every single time. Okay, because remember, the underlying derivative of all this is capital flows, as in whether money's going into the stock markets or they're coming out of the stock market. Okay, fundamentals obviously always play an effect, but really what matters is whether money is going inflow or outflow. It's really as simple as that. You get the best news in the world, but if money's not going into that particular market or stock, it ain't going higher. You know that. Now, in the meantime, this is what's going on. We have an exact symmetry. Now we are up 36.52. We were down 44. So at this point, maybe a little bit move up. Upper end of this, I transpose the Bollinger on it, is 71. That would be severe overbought level. We could get there. We could get there. In the meantime, what's really key to understand is the ADX line here, the directional indicators, right? Right there. And then this. When you have the crossovers, as we are just having a crossover, this is telling me rally continuation. This histogram had just went positive yesterday. Look at this. It just went positive yesterday. Now, there are two ways to interpret it. Bears will say it's a weak indicator because it went positive after such powerful moves in the market, and the bulls will say it's just starting. It all depends on what you look at. What I'm seeing here is that there's a powerful thrust in the market, and this particular